For many investors, realty income is the golden standard when it comes to monthly dividend payouts. Hence the name, the monthly dividend company. And they totally deserve this title based on historical performance. Looking at the current dividend yield, we see that it is sitting at 5.1%, which is an insane number. And they have been growing that dividend over 26 years now, making them a dividend aristocrat. However, if we take a look at the total returns for realty income versus the S&P 500 in the past 5 years, we see a shocking result. Realty income only returned a shy 6%, and this is including dividends. Meanwhile, the S&P 500 is sitting at 106%. So why do people still buy realty income, you might ask yourself? Well, let's find out by diving into the earnings report. And at the end of the video, I will reveal my 3 price targets. Looking at their earnings, we see that realty income beat on both the FFO and revenue estimate. And for the upcoming earnings, analysts have a mixed feeling. In the earnings report, we see that realty income is the 7th largest global REIT with a 11 billion European portfolio. In total, the company owns 335 million square feet and has 1,551 clients in their portfolio. All very impressive, and we will dive in a bit more detail in a minute. Realty income currently has a A credit rating, and this is exactly what you want to see in a REIT. Looking at the financial results, we see that revenue increased about 31%, also due to acquisitions. The net income also increased 31%, so that's a good sign to me. And one of the most important numbers here, the FFO, increased 35%, which is pretty insane. The FFO per share is also looking pretty good year over year. This also shows us immediately that dividends are covered easily with $0.78 declared and an AFFO per share sitting a little over $1. So, as mentioned earlier, realty income has A credit ratings, which is really important for a REIT. Next to that, the net debt to EBITDA is also sitting at a sweet spot with 5.3%. So, this looks really good to me. Looking at their portfolio, we see that this company has a great diversification, with Dollar General being their biggest tenant at only 3.4%. Walgreens and Dollar Tree are also there. And people were commenting on my recent videos that this is a big concern for realty income. And I'm not denying that companies like Dollar General are struggling. And the same goes for Walgreens. But also keep in mind that these companies make up for 10% of the total portfolio. So it's definitely something you want to keep your eye on. But the point I want to make here is that this is the exact reason why diversification is so important. About 10% of realty income tenants are grocery stores and 9.4% are convenience stores. Dollar stores are at 6.6%. So again, this is something to keep your eye on. Personally, I don't mind to have these tenants and industries, but for the future it would be nice to see some other industries there as the biggest. As of right now, the UK is the biggest region followed by Texas, and realty income is focusing on expanding to Europe, so I expect Europe to be there soon as well. The occupancy rate is also at a pretty high level, with almost 99% as of right now, and an average of 98%. The S&P 500 REIT selection is sitting at 94%, so realty income is doing an amazing job here. Another great thing about this company is that the weighted average lease term is sitting at 9.6 years, and that 48% of the leases expire after 2033. As mentioned earlier, realty income is expanding to Europe, and as of right now, Europe is already representing 467 properties in the total portfolio of realty income. And it is expected that in the coming years this will be increasing even more. There is a big focus on grocery stores, and I'm hoping that they will focus on other industries as well to get a better diversification. So let's keep our eye on this number. For the full year of 2024, it is expected that net income per share will be slightly lower than the prior guidance, but still in a healthy range. FFO and AFFO per share are still unchanged, and so is the rest of the numbers. Down the line, this guidance still looks pretty decent. And now that we know a bit more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Realty Income is a 54 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at almost 15.3, indicating they might be undervalued. Later in this video I will show you my 3 price targets for Realty Income stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 4.72 billion, and in this graph we see that revenue went up in the long run. And it has to be said that for a REIT it is growing really steady and consistent. In the past couple of years, revenue really skyrocketed, also due to some acquisitions. We see that margins are going down over a longer period of time, and this is of course something that worries me a lot, especially since 2020 the margins look not that great, and it has to be said that rates only accelerate this even more. EPS is showing similar trends as the margin and revenue. For a REIT it looks pretty decent. Analysis expect that from here EPS increases to $1.97 in 2028, but the pattern is not really steady and consistent. For the revenue, it is also looking very interesting, with an estimate of 6 billion in 2026, and growth numbers are going down each year. Return on assets is sitting at 1.35%, which is a low number, even for a REIT. Return on equity is also looking really low, and the most important number, return on invested capital, is sitting at 1.6%, which is a low number, even for a REIT. It is also lower versus the 5-year average, so that doesn't look good either. Current ratio is at 1.4, which is a decent number for a REIT. Nothing really special to mention here. Historically, it looks pretty good to me. Right now, Realty Income has 26 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Realty Income has 442 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 5.1%, which is a great number. And keep in mind that Realty Income pays a monthly dividend instead of a quarterly dividend. Annual payout is at $3.16 and payout ratio is around 75%, which is the average for REITs. The 5-year growth rate is at 3.55%, which is a decent number. On top of that, they increased the dividends for 26 years in a row, which is really nice. In here we see the dividends paid since 2014. And to me, this looks really good. Realty Income really likes to increase the dividends at a low rate, but over a longer period of time this really adds up. In this graph, we see the expected dividends in 2024, 2025, and 2026. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough estimation. It's expected to grow at the historical rate from here. The increase in 2021 was a supplemental. Overall, these dividends look pretty good to me, but how about the historical returns? I decided to compare Realty Income stock with the overall market, in this case the S&P 500. Next to that I added SPG and ADC. On the 5-year chart we see that Realty Income only returned 6%, and this is including dividends. The S&P 500 returned 106%, massively outperforming Realty Income. SPG did best with 43%, and ADC is sitting at 25%. On the 1-year chart it looks pretty interesting, with the S&P 500 again beating Realty Income easily. However, both SPG and ADC managed to beat the S&P 500. On the 6-month chart it is again pretty interesting, with Realty Income finally beating the S&P 500 with twice the return. But this time ADC did best with a whopping 35% return. On the 1-month chart it is again Realty Income with the lowest return. So bottom line, the S&P 500 was by far the better investment in the past 5 years. And also in the short term it looks like other stocks were the better choice here. But could this be the perfect time to buy Realty Income stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. For the revenue growth I'm filling in 6, 8 and 10%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 15, 17 and 19%, and for the free cash flow margin I'm putting in 66, 68 and 70%. For the PE ratio I'm putting in 20 since it is a REIT. And for the price to free cash flow I'm putting in 12, 14 and 16. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now, Realty Income stock is around $62. I hit analyze and we see one green number. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $48. We have a mid price target of $61 and we have a high price target of $79. To me, the mid to high price target is the most justified here, indicating that this stock is still looking undervalued. Please let me know the price target you think is the most justified in the comments down below. My final conclusion on Realty Income is that it is an amazing company. They have a long proven track record when it comes to dividends, and that's one of the main reasons why people still like this stock. The monthly payout and a high yield is for most people still the golden combination. And that goes for me as well. I also do like most fundamentals. The only thing I'm keeping a close eye on is the tenant and industry diversification alongside the margins. I would love to see other industries and tenants become bigger and a smaller focus on these dollar stores. On the other hand, Realty Income knows this industry really well, so I trust them to make the right decision. For now, I slowly keep buying this stock throughout the year. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.